There is a number that Michael Burry has been watching for years. Not because it is going up, because of what happens when it stops. Right now, simultaneously, American equities are trading at valuations last seen only twice in the last 100 years. The bond market is carrying the largest paper losses in modern recorded history. Real estate prices in major metropolitan areas have outpaced wage growth by a factor of 4 since 2012. And the derivative instruments designed to hedge all of this risk are concentrated in fewer institutions than at any point since the 2008 financial crisis. Burry has seen this configuration before. Not all of it at once, but each piece, separately, has preceded a major financial rupture. Today we examine what Michael Burry has identified as the most dangerous multi-asset bubble in the history of modern finance. The one nobody wants to see. Michael Burry runs a firm called Scion Asset Management from Saratoga, California. He is not on television regularly. He does not give keynote speeches at Davos. He does not manage hundreds of billions of dollars. What Burry does, with extraordinary discipline, is read. He reads annual reports. He reads bond prospectuses. He reads Federal Reserve transcripts and congressional budget projections and academic papers on behavioral economics and systemic risk. In 2005, while every major bank on Wall Street was rating mortgage-backed securities as safe, Burry read the underlying loan files. He read what the banks were not advertising, and he saw that the American housing market was built on a foundation of loans that had been designed structurally to fail. He bet against that system. He was mocked, threatened, and nearly forced to liquidate his fund by his own investors. Then the system collapsed exactly as he predicted, generating returns of 489% for those who stayed. This is the man who is now warning about what he calls the market bubble nobody wants to see. And the reason nobody wants to see it is because the bubble is inside the very instruments most investors use to protect themselves. To understand Burry's current concern, we need to understand what has happened to the structure of financial markets over the last 15 years. In 2008, the Federal Reserve responded to the financial crisis with the most aggressive monetary expansion in American history. Interest rates were cut to effectively zero and held there for 7 years. Then, following the pandemic shock of 2020, rates were cut to zero again, and the Fed's balance sheet expanded by nearly $5 trillion in a matter of months. What this created, over 15 years of near-zero rates, was a singular incentive across every asset class simultaneously. When the cost of borrowing is near zero, every asset that generates any return becomes attractive regardless of its underlying risk. Stocks, bonds, real estate, private equity, venture capital, cryptocurrency, alternative assets of every description. All of them became targets of capital that was fleeing a rate environment that punished holding cash. Burry has argued that this was not a recovery. It was an inflation, not of consumer prices initially, but of asset prices across every category simultaneously. And what makes this particular configuration dangerous, in Burry's framework, is precisely its simultaneity. In prior cycles, a bubble in one asset class could be corrected by a rotation into another. Equities crash, money moves to bonds. Bonds fall, capital moves to commodities. Real estate corrects. Liquid assets absorb the capital. What Burry has identified is a configuration where the standard escape routes are themselves compromised. When every asset has been inflated by the same force, the removal of that force does not create opportunity elsewhere. It creates a synchronized drawdown across categories that are supposed to be uncorrelated. This is what Burry means when he refers to the market bubble nobody wants to see. It is not a bubble in one market. It is a bubble in the concept of safety itself. The instruments that investors believe are protecting them, diversified portfolios, index funds, balanced allocation models, were all designed and backtested in an environment of declining rates that may no longer exist. Burry's core thesis, developed through his public statements, regulatory filings, and rare interviews, centers on a specific structural argument. The extraordinary monetary policy of the last 15 years has not just inflated asset prices. It has systematically trained an entire generation of investors, analysts, and institutions to behave as though the conditions of that period are permanent. Risk models built on 15 years of data assume that bonds and equities have a negative correlation, that real estate always recovers. That diversification across asset classes provides genuine safety. Burry argues that these assumptions are artifacts of an extraordinary and temporary monetary environment. According to Burry's analysis, the transition out of that environment, which began in earnest in 2022, will not simply cause asset prices to revert to historical norms. It will expose structural dependencies that have built up over a decade and a half, in ways that the models used by most investors simply cannot capture, because those models have never been tested against the scenario that is now unfolding. The first dimension of Burry's concern involves the concentration of capital in passive investment vehicles. As of 2023, passive funds, primarily index funds, and exchange-traded funds controlled more than 53% of all assets under management in the American stock market. This is a fundamental shift in how markets function. When Burry studied the housing crisis, he identified a key mechanism. The rating agencies and investment banks had created an artificially homogeneous pool of risk. Thousands of different mortgages, in theory diverse, had been packaged and rated in ways that made them behave identically in a downturn. Index funds, Burry has argued, have replicated this mechanism at the equity level. When an investor buys an S&P 500 index fund, their capital flows automatically into every component of that index, weighted by market capitalization. The largest companies receive the most capital, not because analysts have evaluated them and found them most valuable, but because they are already the largest. This creates a reinforcing loop. Price rises because capital flows in. Capital flows in because prices have risen. Burry has described this as the destruction of price discovery, the mechanism by which markets are supposed to allocate capital efficiently. According to Burry's analysis, what remains when price discovery is gone is not a market in any meaningful sense. It is a momentum machine, and momentum machines, as 2008 illustrated in the bond market, can sustain apparent stability for a very long time, until they cannot. The second dimension of Burry's framework involves the bond market, which experienced its worst calendar year in recorded history in 2022. Burry has long argued that the bond market contains a structural dislocation that most analysts have chosen to ignore, because acknowledging it carries implications too destabilizing to model professionally. American government debt stands at levels historically associated with outcomes ranging from financial repression to outright default or inflationary monetization. The Congressional Budget Office's own projections show debt to GDP ratios on a trajectory with no historical precedent in peacetime. What makes this relevant to Burry's broader thesis is the role that bonds play in the portfolio construction models used by virtually every institutional investor on Earth. The classic 60-40 portfolio, 60% equities, 40% bonds, is predicated on the assumption that bonds rise in value when equities fall, providing a cushion during market stress. Burry has pointed out that this negative correlation between stocks and bonds is not a law of financial physics. It was a product of a specific environment of declining rates. In environments where inflation is structurally persistent, which Burry has argued we may have entered, bonds and equities can fall simultaneously. When the cushion falls along with the asset it is meant to cushion, the standard portfolio construction model does not just underperform. It fails at its core purpose at precisely the moment it is needed most. The third element Burry has flagged involves the real estate market, and specifically the relationship between housing prices, consumer balance sheets, and the broader economy. American household wealth is more concentrated in real estate than at any point in modern history. For the majority of American households, their home is not just where they live. It is their primary asset, their primary store of value, and their primary mechanism for accessing liquidity. Burry has argued that the inflation in housing prices since 2012 and the acceleration of that inflation during the pandemic period has created a dependency that is structurally similar to what he observed in 2005. Then, as now, the apparent wealth of millions of households rested on the assumption that the asset underlying their borrowing would continue to appreciate. In 2005, that asset was a house bought with a loan designed to fail once introductory rates expired. Today, Burry has noted, the mechanism is different, but the dependency is structural. Millions of homeowners are locked into properties they cannot sell without triggering capital gains taxes that would consume a substantial portion of their apparent gains, while simultaneously being unable to refinance or move without accepting mortgage rates that are dramatically higher than the rates they locked in during the zero-rate period. This creates a frozen market with the appearance of stability. Prices do not fall because almost nobody is selling, but with an underlying fragility that Burry recognizes as characteristic of markets that are one shock away from a rapid repricing. The fourth element of Burry's analysis involves the concentration of financial risk in fewer institutions than at any point since the pre-2008 period. The response to the financial crisis involved the consolidation of the banking sector, with the largest American banks becoming substantially larger through federally assisted acquisitions, and the creation of regulatory regimes that, Burry has argued, pushed risk into the shadow banking system rather than eliminating it. Today, the derivatives market, the complex instruments used to hedge equity, interest rate, and credit risk, has a notional value exceeding $1 quadrillion globally. Burry has consistently argued that the concentration of this risk in the books of a small number of globally systemically important financial institutions creates the same category of problem he identified in 2008. The risk has not been eliminated. It has been relabeled, reorganized, and moved to places where it is less visible. According to Burry, this is not a solution. It is the precondition for the next crisis. The fifth, and perhaps most uncomfortable element of Burry's framework, is behavioral. Burry has written extensively about the role of human psychology in creating the conditions for financial catastrophe. His argument is not original. It draws on the work of Hyman Minsky, who described how stability itself generates instability by encouraging progressively more speculative behavior. The 15-year period of rising asset prices across all categories has trained an entire generation of retail investors to treat market corrections as buying opportunities. Every significant drawdown since 2009, the European sovereign debt crisis, the 2015 China shock, the 2020 pandemic crash, was followed by a rapid recovery to new highs. This consistent recovery has not created sophisticated investors. According to Burry, it has created conditioned ones. Investors who have learned, through 15 years of reinforced experience, that the correct response to any market decline is to buy more. Burry has argued that this behavioral conditioning is itself a systemic risk, because it means that the early stages of a genuine structural correction will be absorbed by investors who are trained to interpret it as an opportunity. This buying will slow the initial decline, potentially for months or even years. But it will also mean that when the structural break finally becomes undeniable, the retail investor base will be more deeply invested than at any prior inflection point, having added to positions throughout the early stages of the correction. Burry does not publish investment advice for retail audiences, but his methodology, consistently applied across more than 2 decades of public analysis, suggests a framework that any investor can study. The first principle Burry embodies is the discipline of primary source analysis. Burry does not rely on analyst summaries, financial media headlines, or the consensus views of institutional economists. He reads the actual documents, the 10K filings, the loan prospectuses, the Federal Reserve's own projections, the congressional budget documents. Applied to your own situation, Burry's methodology asks a single question. Do you understand, from primary sources, exactly what you own and exactly what happens to it under adverse conditions? The second principle is a rigorous analysis of liquidity under stress. Before every position, Burry models not just the upside scenario, but the exit scenario. Not the best-case exit, when conditions are calm and buyers are plentiful. The worst-case exit, when conditions have deteriorated and every other investor wants to leave simultaneously. If the worst-case exit is acceptable, the position is acceptable. The third principle, and perhaps the most difficult to maintain psychologically, is the discipline of acting on your own research against the consensus. Burry was wrong, in the eyes of every institution he dealt with, for 3 years before he was right. That requires a quality of independent conviction that is rare and costly to maintain. Burry's record suggests it is also the only quality that produces the results he has achieved. Today we have examined Michael Burry's framework for what he identifies as the most dangerous multi-asset bubble in the history of modern finance. We traced the structural arguments he has developed regarding passive investing and the destruction of price discovery, the bond market, and the failure of traditional portfolio construction, the real estate market, and its embedded dependencies, the institutional concentration of systemic risk, and the behavioral conditioning of an entire generation of investors. Burry's record is not perfect. He was early in 2008, and being early looked identical to being wrong for a painful period of time. What Burry represents, in the history of modern finance, is the discipline of seeing what the consensus has agreed not to see. The market bubble, nobody wants to see, is not a new phenomenon. Every bubble in financial history had the same characteristic. The people inside it did not want to see it. The mechanisms that made the bubble profitable also made it psychologically costly to acknowledge. This is the configuration Burry has spent his career identifying, not the bubble that everyone is talking about, the one that the talking is designed to avoid. Whether Burry's current analysis proves correct will be determined by time and data, not by this examination. What we can say is that the framework he has built, over 25 years of concentrated study, is worth understanding. The question Burry's work leaves open is simple. Are you looking at what the consensus is not looking at? Because according to Michael Burry, that is where the answer always has been.